Business owners, here's a dangerous mistake: looking at your bank balance and assuming all that money is yours to spend. It isn't. Some of that cash may already have another destination, the CRA, and spending it today could create a serious cash flow problem tomorrow. Introduction. Hi, I'm Us Melbourne, founder of Melbourne Accounting Solutions. Today, I want to talk about something that catches many business owners by surprise: tax money sitting in the business bank account. The balance may look healthy, but the number on your screen doesn't tell you how much of that cash is actually available to spend. Imagine your business has $80,000 in the bank. You feel confident, so you buy equipment, pay down some debt, maybe even take additional money from the business personally. Then your accountant tells you, "We need to discuss your upcoming tax obligations." You may have GST/HST to remit. Payroll source deductions may be due. Corporate income tax or installments may also need to be considered. Suddenly, that $80,000 doesn't look like $80,000 anymore. The problem wasn't necessarily that the business didn't make enough money. The problem was treating committed cash like available cash. Here's the habit I want every business owner to develop: separate your operating cash from money being reserved for taxes and other obligations. Depending on your business, that means planning for items such as GST/HST collected that may ultimately need to be remitted after applicable adjustments and input tax credits, payroll deductions and employer remittances, corporate income taxes, tax installments, where required, upcoming supplier and financing obligations. And remember, GST/HST collected isn't automatically business revenue. Your business is collecting those amounts as part of Canada's sales tax system, subject to the applicable rules and credits. Treating everything in your bank account as spendable cash can create a painful surprise when remittance deadlines arrive. Why this matters. Tax problems often begin as cash flow problems. The business earns money, the owner sees cash, the cash gets spent, then the tax deadline arrives. Now the business has to find money that should have been planned for months earlier. Depending on the situation, late payments or remittances can also result in interest and penalties. That's an avoidable problem. Strong businesses don't wait for tax deadlines to figure out how they're going to pay. They plan throughout the year. Cash in the bank doesn't necessarily mean cash available to spend. Know what belongs to your business. Know what's committed, and plan accordingly. At Melbourne Accounting Solutions, we help business owners understand their upcoming tax obligations before those obligations become surprises. We can help you look at your financial position, anticipate upcoming requirements, and build tax payments into your cash flow planning. Because paying taxes may be unavoidable, being financially unprepared for them doesn't have to be. If tax deadlines regularly leave you scrambling for cash, let's have a conversation. Your tax obligations should be part of your financial plan, not an emergency. Look at your business bank balance today and ask yourself, how much of this money is truly available to spend and how much is already committed? If you can't answer that confidently, that's a number worth understanding. I'm Us Melbourne, founder of Melbourne Accounting Solutions. Our mission is simple: to help Canadian business owners make smarter financial decisions, reduce unnecessary taxes, and build stronger businesses. If you found this lesson valuable, please subscribe to our channel so you never miss future business, tax, and financial insights designed to help you succeed, helping Canadian business owners learn, grow, prosper. Thanks for watching, and I'll see you in the next lesson.